Good day, everybody. This is Jim, the option professor speaking, and today I'm going to go over psychology, discipline, and time management when you're trading. A little background on myself. I have been in the investment markets for a long time, decades, and I have had extensive training in the option area, including the Options Institute in Chicago, CBOE, for advanced options training. And I've also conducted hundreds and hundreds and hundreds of seminars throughout the country on options to thousands and thousands of investors. So my educational background, I'm a graduate of Boston College. And so again, with the background and the experience, I have a certain amount of knowledge I'm going to share with you today. What I'm not going to be sharing with you is advice. So I don't know all of you. I don't know your circumstances, risk tolerance, and suitability. That's why you go to your brokerage firm and figure out what's right for you. But I am going to share my opinions, and I'm going to share you my views on a bunch of different markets. And I'm going to share with you the philosophical things that I've got when I talk about psychology, discipline, and time management. Now, I'm going, at the end of the broadcast, I'll explain how I could help you one-on-one. Here we go, on the S&P 500. Now, as far as discipline is concerned, one of the disciplines I like to use is the moving averages and the relative strength. One is to tell me what the trend is doing, and the other is to tell me what the momentum or speed of the market is doing. And I have my own opinions on, obviously, which averages make sense and their interaction. So I'm showing you some of them here. And I have my own opinion on the relative strength index and what it means at what levels. Okay, so I'll share some of that with you today. And then we'll look at some stocks and we'll see how it looks. I want to start out with the broad-based index first. You know, the S&P 500 obviously is the Cadillac of all the indexes. It has a pretty heavy weighting of tech in there, so it gives you some of the QQQ, but it also gives you other different types of stocks like the value stocks. Some value stocks are in there and some different stocks like that. So it is, and in my view, my opinion, wherever the S&P goes, the others go at a different pace. With regards to the S&P, the week that just passed, we did have the Fed come out, and they did make an announcement that they were going to try to keep these rates steady until they get identifiable data showing that the inflation is actually coming back down. So that's going to take a little bit of time because this information comes out weekly and monthly, not daily. And so, again, there'll be some water under the bridge before they revisit it again. Their next Fed meeting is in June on the 11th, and then they go July 30th, and then they take that break from Jackson Hole. So again, getting back to the main things here is the discipline. Now, my discipline is I like to look at everything from a long-term, intermediate, shorter term, and very short-term basis. So I'm going to walk you through how I feel about the stock market right now. First of all, as you can see, we've been in an uptrend ever since 2008, right? The blue line hasn't even gone pointing down ever the entire time. And purple has been rising, and so has gold. Those are longer term averages. The shorter term average on red obviously has turned down a couple of times. It turned down in 2021 when we had the big drop. It barely turned down during the crash of COVID. And if you notice, you know, if you are patient and you watch it go back up above the blue line, you get a pretty good idea that it's going to go back up, which is basically what we saw last year. Now, the other thing is that the purple line and the gold line are longer term averages. And so if they ever get violated, boy, that would be very, very serious. The last time the gold got violated was back in the great financial crisis. So you start seeing the gold line blowing out, you're going to have a problem. So that gives me a discipline of knowing what the trend is as far as what this is indicating. So when we get corrections down towards the averages, I know that I'd be more interested in buying than selling. Now, let me give you a good for instance. When we went to the 4,100 area back last October, can you see all these averages were converging at the same price? Look at them. They're right on the board there. 42.45, 4,200, 41.98, right? And then the next month over in November, same. They're all converging, okay? So we know that at the end of October, when he comes out and says that we're going to get cuts in 2024, the implicit reasoning behind that, in my opinion, was to avoid the market crashing. Because had we broken under 4,000 there and he never came out with that comment, then you would have probably had some problems and maybe even gone down to 3,000 there, because once you get under here, there's nothing underneath to hold you. But I think that was a very strategic comment by Powell back in October, end of October, November, because that gave everyone the green light to get into the market. Now, the problem after this rally was what? That we do not have any cuts, and it's now May, and we just found out we're not going to get a cut in May. So the earliest you could ever get a cut is June or July. Now we're 6 or 7 months into 2024, where the guy said we were going to get cuts back last October. So he's starting to look like he might be losing some of his credibility. I mean, you know, inflation was going to be transient and all that stuff. But getting back to the discipline, this is more the psychology of the market, where if everybody is doing something like selling out down here to 3,500, psychology is very negative, position's very negative, and if they can turn it at all, it's going to go. Up here in 2021, psychology was buy, and this is called reversion to the mean. So that's where the discipline of the moving averages comes in. I'm not going to be interested in the market up here. I'm not interested in the market up here because it is too far away from the averages, and there's a high probability, in my view, of a reversion to the mean. So my discipline is don't do any buying there. Do your buying here. Plant your seeds here. Harvest up here. Don't plant your seed during the harvest. That's a discipline, right? That's a discipline. And again, psychology is that if everyone is in and it's extended, good chance it'll come back. We just saw it again last month in March. Everybody's in, and there's a chance that we're going to have a pullback now. It's possible, okay? Odds, right? So we have to be careful of that. And again, it's certainly not as good a time to buy up here as it was down here from the standpoint of risk reward. Because if you buy down here, you have a discipline and you could get out if it breaks underneath here. If you get in up here and you have to get out if it gets way down here, that'll be a substantial loss if it happens to change on you. So that's another reason why the discipline of the moving average is very helpful. The interaction of the moving averages is a discipline as well. Can you see that when the markets green, blue, and red are all pointing higher and rising, this market is going higher. And even if it gets interrupted, you have to look at this type of movement as a false movement, in my opinion, because the averages are still pointing up. And so once this COVID thing happened, what did they do? They expanded the balance sheet from 4 trillion to 9 trillion to make sure that this thing ended quickly. And did it end quickly? Like, how about within a month? So here you got right back on the horse if you're looking at this discipline, and you're back in there making some good bucks. Okay, so the moving averages for me is a discipline, and I like it. The other thing that's a discipline is your relative strength index. Broad strokes on the relative strength is if we're above 50, you're generally in a strong market. If you're under 50, you're generally in a weak market. Then there's some other points that I use, which I can talk to you after the broadcast and basically explain, which tells me when the acceleration periods are going to commence, or if they're not going to commence, where that could be a top or a bottom in the market. So the relative strength I use to either A, get the general feel of the market, positive, negative, or it tells me acceleration periods are coming, or it tells me acceleration periods are not coming, and the market is at a top or a bottom. Okay, so those are disciplines, and I have actual numbers that I use on that. And again, I just gave you the 50 plus or minus is one of the numbers I use. And again, they're not etched in concrete to the penny. I mean, you notice here it went to 50 almost exactly. Over here it went to 49. I mean, 49.40 is 50. You know what I mean? It's not something we're going to get the National Guard out on if it only goes through by a penny. So anyway, that gives you a little bit of an idea. Now, so what's the view? Let's go over what's the market now. Okay, we got our discipline, moving averages. We got our psychology, which comes really from the relative strength as well, because when relative strength does certain things, it tells you the psychology is one thing or another. I also use the VIX. I'll put that up here so you can get a look at that too. Again, I'm an option guy, right? So volatility is a big thing to track, right? All right, okay. So here's what I told people here recently, and it worked out pretty good for them. If you go back to the last 7 years, now let's go back to 2017, and you see in the month of April, the VIX had a low of 10 and a high of 16. And then the next month in May, it had a low of 9 and a high of 16 again. So that's a very big jump percentage-wise on the VIX. And that's why I was thinking April, May could be vulnerable to people. Now go look at 2018, what happens during the April time frame. Wow, look at February, it jumps from 12 to almost 50. And then even the next month over, it's 13 to 26. And even the next month over in April, it's 15 to 25. And then it comes down in May. So the bottom line is I was very, very, very confident that April was going to be a bad month for stocks, because I was expecting for the VIX to spike up. Now let's go over 2019. And 2019, we see in April, it went from 11 to 14, but look what it does in May. In May, it goes from 12 to 23. So April, May, you know, expect the fireworks historically. Look at 2020. In 2020, in March, you had the VIX go from 24 to 85, followed by another month of volatility, 30 to 60. And even May was no wilting flower. It's 25 to 40. Then you go to 2021. Now, again, if the VIX is going to spike, markets are coming down. Okay, that's just the way it works, historically, in my view. Again, I'm sharing you my opinions here. In 2021, we had April, the VIX went from 15 to 20. And look in May, it goes from 15 to 30 almost. Another year. 2022, okay, you had VIX in March go from 18 to 37, right? And in April, it goes from 18 to 34. And then in May, it, I think, quieted down a little bit. Yeah, quieted down, but it's still pretty volatile. So that's 22. Then we have 23. How did it do in 23? 23 February, but not too much. What about March? March, it went crazy. Went from 18 to 30. And April's calmed down, but then look what May did. I think May had a big, well, again, March was the big month there, but it's, now here's what we saw this year. First of all of these seem like they're higher lows, right? Higher low December, and then higher low, except this one right here. But that one right there might have just been a snake job, because what happened in the month of April? You went from 13 to 21, and we got a pretty good drop in April. So that made me a little bit concerned that the stock market might roll down. I'll tell you what really made me thought the stock market was going to roll down, in addition to that, was the charts. And I go over to the 1-year graph, and I see this thing. Oh, let's go over to, by the way, that's the spike up in the VIX I was telling you about. There it is. Okay, so let's go over to SPX again. And let's take a look what happened and what would make me think it's rolling over. This is what makes me feel like it's rolling over. The red line turns down, the green line turns down, and now blue looks like it wants to turn down. So this thing obviously has more potential on the downside if they're going to have a full Monty correction. Now, a full Monty correction would be very attractive to the Fed, because then people might stop spending money like a drunken sailor. Maybe some of these economic numbers would slow down, and then they could cut in July, where now the bets are there's no cuts coming at all. I mean, talk about Jekyll and Hyde. We go into the year looking for 7 cuts, then they're looking for 4, then looking for 3, now it's none, now they're looking for possible hikes. Well, again, if we get a drop to here or here, that would take the bloom off the rose. And then if the economic numbers turn down at all before July 30th, July is still on the table as far as I'm concerned for a cut. If they don't, then it will be no cut this year. And if they don't, and the 10-year note, which I'll show you in a minute right now, again, following the discipline of the moving averages, right? And again, look at the RSI. Are we under 50? That's not good. Again, it broke under 50 in April. That's when I thought things were rolling over. So far, that's exactly what they've been doing. Today, last week after the Fed meeting, the market went nuts on the upside, and by the end of the day, it was right back down again. Why is that? Because the trend has rolled over. Okay, now it might roll back up. When it does, I'll act accordingly. Okay, now we were going to look at the 10-year note. This is interest rates. This is interest rates. And then I'm going to go over some individual stocks you can take a look at, individual commodity markets and stuff like that. And so whatever you're looking at, I'll probably touch base on it a little bit. If not, after the broadcast, you email me or send me your information, and I can go over any of the markets you want to go over. Anyway, this is a 20-year graph. So obviously rates started to turn up in 2021, and they've been rising ever since. So this is no new rise in interest rates. Now they've tried to bring it down a few times, right? So this is the yield on the 10-year note. You see, they brought it all the way up here to 4.33, and then they brought it all the way back down here to 3.25, right? But the trends are all up. The lines are all pointing up. So that's why rates higher for longer is the story. That doesn't mean you can't revert to the mean. That's what it just did here. Okay. Remember, we just went from 5% back in October. Then he says there's going to be 7 cuts coming or whatever he says. And we revert back to the mean. That's all we did. And now we're right back on the bicycle again. Okay. Now, where does it end? I don't know. I mean, you know, rates back here in 2007 were as high as 532. So I don't know if it's going to keep taking, I don't know if it's going to take out that 5%. If the numbers keep coming in hot, it will. On the 5-year graph, again, could we revert back to the mean? Well, where's the mean? It could revert back towards 420 to 433, where it took off from. It could revert back down there. Okay. But it would have to really start getting under 4% before anybody could really make any kind of comment that there's some kind of a sustained move for lower interest rates. Here you go. And some of these numbers are all coincidental. You see, this is in the 440 area, and this is in the 420 area. So that's why, you know, 440, 420 ballpark area, these are very important numbers. Now, in the 1 year, the yields dropped a little bit today. So obviously they're coming down. And there's room there. So there could be more, a drop on it. But you see, the red line is not pointing down. Green, definitely not. Blue, forget about it. And so, you know, to get a sustained drop, like you got a sustained drop in yields up here, didn't you? Right? But did you notice all the lines are pointing down? And that's the discipline. Otherwise, people are coming on TV saying rates are going down, rates are going down, and all it does is cost you money. You know, if you're buying bonds, you're losing money on bonds still. And if you bought bonds, you know, when rates were really low, I mean, look at this. Say they got you buying bonds down here. You realize the bonds are probably down maybe 25% up here? Now, bonds people buy for safety of principal and income. Well, certainly you're not getting safety of principal in the bond market. At some point you might, if they can take the rates back down a bit. But it's certainly not been a very good investment as far as the principal is concerned. Thank God you get a coupon. But if you bought the bonds down here, you got a lousy coupon and you're losing money. That sounds pretty lousy. Okay, so that gives you a little bit of an idea of what's going on with interest rates and a little bit of an idea of what's going on with the S&P and also the VIX and also interest rates on the 10-year note. It gives you a little bit of an overview on that kind of stuff. Now, again, time management is another thing we're going to talk about. I like to do research on the weekends when the markets are closed, or I like to do it in the evening when the markets are closed. And then when the markets are open, then obviously you can employ whatever your research has told you to do. If you're a day trader, obviously you got to do it during the day. And if you're doing day trading, you know, the averages that I work with, they can be used for any time frame at all. So let me show you a little bit about that. Hang on. I'll put up the S&P. And you can see on the S&P, if we go to the 1 month graph, shorter term, it's been a pretty good seller here all the way up. And look, we rallied after, we rallied after the Fed meeting, right? But look at that stem. It went up to 5,100 and it said what? The lines are pointing down. We got nothing but resistance above, right back down here. Okay. On a 1 year graph, what's the action today? Look, it went up towards the green line and came back down. And the red line is at 50.43 and it closed under 50.43. So obviously that's not a very good sign because everything's still pointing down and we're under 50 on the RSI. So right now you're holding a little bit of a time bomb on the stock market basis the trends. Okay, you do it on a 5-day basis here. Again, trends are telling you it's up, trends are telling you it's down, popped up very quickly, but remember I told you, if all the averages are pointing down and it does something like this, you could figure that that is a baloney move. Because again, these things don't turn on a dime. And this thing is a move that, it would have to stay up here for a while to turn time and price around, right? And so that's the beauty of this. If you're a trader and you see this, you might start looking at a place to do selling up here because you feel that's a false move, particularly if it's something on news. I'll show you a stock on the pot stocks that had the same thing happen. It had news that they were going to reclassify pot out of the heroin area or something like that. So again, you've got a 1 year graph here, and you can see that a lot of the averages were not really moving up very well. On a 5-year basis, again, they look better. They look better. Exactly. Buying against here is where you want to be on those pot stocks. So as long as this particular stock can stay above 1150, you're onto something possibly. But on a short-term basis, you can see that the red line was pointing pretty much down. It popped up a little bit because of yesterday's action, but it is not pointing up. Green is definitely pointing down still, and it closed under green. So this move here is enormous. But if it's based on news, and then the guy who runs the house, Mike Johnson, says we're not going to be passing any pot reclassification, then there you go. The news that drove it up quickly. Market makers sold all the stock up here to people that are buying. All the people who are short the stock down here, panicking out of their shorts. Who's buying? Market maker. He's up here giving you all you want to eat. And now he's short. You're out of your, and you bought it up here. And now right back down again. So these over-the-counter stocks obviously can have some liquidity problems when the market maker is the only liquidity on the other side of the trade. But I just want to give you an idea that when these averages are not supporting the move, it can reverse the move very quickly. Okay, let's take a look at some of the different indexes, and then you'll have an idea of what's going on a little bit. Let's start with QQQ. And then we'll talk about a few of the individual issues. Okay, on a 20-year basis, QQQ, again, well, let's go to a 5-year. Again, it rolled over a little bit. It has reversion back to the mean potential, but certainly it could go right back up again. It's trying to hold the 50 number. So this is a very important area for it to be able to maintain. So let's see if it can hold this neighborhood of around 420. If it can, you got a chance for it to go back up. If it can't, then in the soup it goes. On a 1-year basis, again, got to hold this 420 level. You see? See, hold that for, this is the discipline. You can see the discipline right there. And then, of course, the psychology is when people are dumping it and it's support, then you buy. And then if it goes up to resistance, that's it. So there's a lot of resistance on it in this neighborhood. If it can't get through that neighborhood and it breaks purple, it's going to have a more significant drop. So there's your numbers. What's your parameters? People say, what are my parameters? Resistance, 432 to 435. Support, 420, 424, 420. And if it gets underneath the 420, it's going to be possibly problematic, particularly if they can accelerate through the 419 area. RSI is under 40, never a good place to be if you want to be bullish. But if they can't break it under 420, then that 40 RSI could be the bottom of the market on the pullback. So that's why this neighborhood on RSI, that's why this neighborhood of 420 is very important for QQQ. If you want to be bullish, it's what they call the last stand you want to make before it starts folding its chair like a lawn chair. If it breaks under 420, you start seeing RSI 35. I would think it's very possible we've blown out 410 and it looks very bad. So very important area. Keep an eye on QQQ. All right, now we're going to go over to your small caps. And we will see on the small cap Russell, small caps, obviously are interest rate sensitive. I think over half the companies make no money in this thing or more. I don't know. Anyway, you look at a 5-year graph on it, and it is trying to hold on for dear life. The red is trying to turn over at around 202, and the blue is trying to hold support at 190. So you are monkey in the middle here, and it's trading 196, 197 as we speak. Trying to hold on to the 50 number, that's good. So this one's pretty easy for me. If you started trading above red, which is 202, this thing could start taking off a bit and maybe even take out 210 if they get red to turn up. Green's already turned up. So above 202, definitely be interested in the bullish side. And then this RSI, which is hanging on for dear life at 50, will start turning up. That's all good. If we do blow out 190 and red turns down and green turns down, and they ever take out this gold, then the acceleration to the downside could very well start. So you got good parameters there. Right now it's monkey in the middle, and that's not a great place to make decisions, in my view. Looking at the 1 year, again, you got green pointing down. The high today on green was, look at the high today, 200.32, and green is at 200. That's pretty close to the high, right? And it backed off. So that tells you a little something. Purple's rising. That's not a bad thing because that's a longer term average, hard to turn around. So where do we want it to hold? What did I say? 190? Yes, I did. 190, you want it to hold, and you get above 200, 202. That'll open the door to see if this thing can go up. But blue's pointing down, and that's not a good thing. When you make a lot of money in this stuff, the blue's pointing up. Blue's not really pointing up right now. Green pointing up when you're making a lot of money, right? Green's not pointing up. So got to be careful here. Again, I'm not a big fan until we get some strength, sustained strength. There's a gap up here, so could they go up there and play some kind of game and fill the gap up here at around 204, 205, and then tank it again? Yeah, that's possible. So be careful if there's a breakout, but these averages don't turn up. It could be a fill the gap deal, suck people in, only to take it back down. In fact, if you look at the 5-year graph, one of the great highway robberies is this thing up here. This market was rolling over. All the averages are rolling over for whatever reason. They got it to go up here to a brand new high at 245, and it lasted like a week. And within 2 weeks, it was right back in the soup again. So this is another example of if the averages aren't pointing up, then these kind of rallies can be false. Be very careful of them. Okay, be very careful. Okay, so that gives the idea of the Russell. Russell right now, like I say, in the middle, rolling over, gets back above 202 and change. Unless it's just going to try to fill the gap at 205, it could be turning. Likewise, under 190, 180, this thing is going in the soup in a very large way, probably. So there's your small caps, and now let's take a look at, now we looked at QQQ. What about some of the big stocks out there like NVIDIA? And we have earnings next week. We got Berkshire on this weekend. We just had Berkshire. But let's look at NVIDIA right now. Again, when stocks go up like this, people say, what do you think? I go, what I think is you should have bought it down here at 150. You had another chance to buy it at 400. And if you didn't buy at those two levels, then you should leave it alone. Because this is called too high to buy and too strong to sell. And it's going to have a reversion to the mean. And that's exactly what it did to the red line. And it only went to 750. Now it has great earnings. Their revenues went from 6 trillion to 6 billion to 22 billion during the last report. If they come out with a number 22 to 25 billion again, it's very possible this thing gets back on the bicycle again. Very possible. Again, though, this is not, in my view, some kind of a low risk area to be fooling around with it. But on a 1 year basis, Again, everything kind of pointing down. So if this thing starts trading underneath the 835 area again, 800 area, it's got downside potential because everything is kind of rolled over. Okay. Where would you want it to get above? I'd want it to get above 860, 875 for it to look like it's getting back on the bicycle. So there's your parameters, 860, 875. That would mean it looks like it's back on the upswing. But you know what? To make big money on the upside, you're generally going to have green and red on the other side of blue and rising. And that's not happening right now. So I'm not very interested in NVIDIA. Their sister there, Super Micro Computer, was having a very hard time as well lately because it is overbought. And we'll go to the 5-year graph on that. And this is called the poster child of overbought. And this is called reversion to the mean. So do you understand why I try to tell people, don't get sucked in when things are up that high. If you missed it, you missed it. You had all these times to get into it last year, 6 months to get into it. And then even on the breakout, you could have got into it. Maybe even on a pullback here, where it goes from 1100 down to 700. At least you're close to the red line that's rising. So again, you had opportunities against it. Now it broke way through the red line and it went all the way down towards green. So right here is another opportunity to buy on a dip at the area of 671 because the green line comes in at 644. So, it's not very far away based on this kind of stock. So that's another example of you're going to buy the dip, try to use your entry levels with the discipline of the moving average. Okay. One that got hit very badly. Let's see what's going on here. I guess the year of the $7 coffee is coming to an end. Starbucks whacked very hard last week on earnings. So let's take a look here and see what it looks like on a longer term basis. Yeah, see, it came down to purple. So I would look at this neighborhood here to see if it's going to hold. What neighborhood? The $74, $75 area. If it can hold the $74 area, $75 area, rather than everybody in the world selling it, it could be a buy. The problem is your RSI is well under 50 now, and it's at 36. So maybe this was the acceleration to the downside because we broke 40, but maybe there's a little bit more to go. Let's see if there's anything on the 5-year. And obviously the 5-year was telling you to sell it, sell it. And remember I told you about the baloney rally? There it is again. Baloney rally, because everything is still pointing down. So whatever the heck that was all about, it should have been sold. Even up here, baloney rally, everything's flat, right? So you're accelerating to the downside. Could this be the end of the acceleration? It could be if, in fact, what? It can hold the purple line. It's the only thing I would play it against. I played against purple. If it can't hold purple, then forget it. And it did penetrate it, so it would have to get back on the bicycle to get back above 75. But that neighborhood would be and that's catching a falling knife personified. So totally not my cup of tea. I like to be in things when they look like this, right? And like that. That doesn't look like that, okay? So it's really not that great of a deal because all you're looking for is a reversion to the mean trade, which could happen, but it's risky. Okay, what else? There was a couple of other ones that were kind of newsworthy here after earnings last week. CVS, I'm just trying to get some Nightmares on Elm Street out of the way here. CVS is a pharmacy, right? And apparently people aren't using the pharmacy as much because this thing got hit last week like this. And look, again, see, it didn't even hold gold, went right through gold. But if you were interested in it and you wanted to trade on the panic here a little bit, you'd want that 57 number to hold up. So right now we've gone through it. If it went back above it and held, there's a big gap there. So that could be something. Other than that, it's similar to Starbucks. I mean, this is no surprise that it dropped, right? It should be no surprise to anybody that it dropped because it's been lousy for a long time. But could this be capitulation? We'll see. What would make you think it at all? On Starbucks getting back above 75 and on this baby getting back above 57. Okay, so that's and let's see how it plays out. Let's see how it plays out. Because those numbers, basis what I look at, that discipline that I use is very good. And again, another question about being patient. When things are up here and the averages are down here or down here or down here, and you tell people, hey, listen, be patient, and it rolls over, be patient, be patient. Don't just buy because you got money in your pocket, right? Okay, let's look at some of the ones that I have liked in the last 90 days. Some of them I've already exited, but let's take a look at it. First one would be the industrial metals. And the point man on this is Freeport-McMoRan. And as you can see, let's look at the 1-year graph. Again, reverting back to the mean. And if it has further reversion, it can go down to 48. If it breaks 48 and these averages turn down, you could have a much more substantial correction and filling that gap. If the stock market drops, if the economy slows, if these economic numbers, which are definitely coming in slower, if that all leads to any kind of a recessionary type slowdown, Freeport-McMoRan is going to get whacked probably, and probably going to have to go down and fill these gaps. So keep an eye on it. If you own it, certainly underneath 49 bucks is not a friend to you. And again, getting the red and the green to turn over is not a friend to you. So be careful of that. On a 5-year chart, again, it has a reversion to the mean possibility going back to 45 bucks. So keep an eye on that. It has been a great thing to be involved in. I mean, come on, I like this thing at 38 bucks. You see this? That's where I was interested in it, right? Because I could see everything was turning up and RSI was getting above 50. Great time to get on board. And then let it ride, let it ride. And now it's choppy enough to do something about taking money off the table or hedging it or whatever you do to protect yourself. Another one in the same genre is Southern Kappa. Same chart, same idea, no big difference there. But what a ride, huh? 80 up to 120, not bad. Then there were some precious metal stocks that I liked. One was the Pan America Silver. And Pan America Silver was looking great in the 12 area. And then you can see once it got above 1250, turning up, and then up and away. And then this is where you got to do something of either protect your gains, take something off the table, change your risk management. Again, time management is one thing. Again, that's the time you set aside to do your trading or your research. Risk management is when you get onto something like this, you don't want to have the thing coming back down and lose all your gains. So you got to know ways, if you're in options, to roll up the position, spread the position, replace the position or something. And again, if you don't understand what all that means, after the broadcast, I can explain how you can get a hold of me and I can go through it with you. Okay, so that was one there. And then, of course, the big daddy of them all, Newmont Mining, that was another one in the 30s that was a fabulous buy. And that's a gold stock that announced very good revenues. And they got rid of a lot of stuff that wasn't paying off. Plus, they joined forces with that company in Australia. So, this thing was a garbage can, right? Look, I mean, it's coming down all the way down here. But once you got above 30, 31 here, got to start taking a look at it. Gold's taking off at that point. Then it gets above blue, 33, and then it announces earning as it goes to 44. Now, I'll tell you right now why I thought 44 was a good time to get out. If you go look at the 20-year graph, I mean, the thing came right into two averages. Look what the high is, 43.91. Look where the averages are, 43.75, 43.38, right? And the RSI on the long-term graph is still under 50. So this thing was basically a dead cat bounce, a very big one, but it was time to get off the table there at that point, and that's what I was suggesting people entertain, is the idea of hedging, taking money off the table, spreading them, whatever you do. But you got to do something when it hits those two numbers, I think, because, again, green's no joke, and it's pointing straight down. So keep an eye on that. You see where it has to get back above to get cooking. If it gets above there, then you can go up to 50 or higher. But then if you look at the price of gold, you'll see that it was running into some problems there. And those of you who, no, let's take a look here. Gold's up 20 here on this graph. If you look at the 20-year graph on it, you see it's very, very extended up here. So you got to be careful. When it gets this far away from the averages, it's susceptible. right? 5-year graph, it's susceptible to a reversion to the mean. That does look like a potential down flag up pole, very similar to what we saw over here, which was a little bit of a down flag, and we got an up pole. So if we got another up pole like that, we're into probably 2,500. But to do that, you're going to have to get above 2350. So if we can get above 2350, 2380, I think maybe we're going to have a big spike up. If not, that red line's pointing straight down. It held the blue, which is great. Look at it held the blue. What was the low? The low is 2291. Where's the blue? 2296, pretty much right on the number. In fact, it was the number. There it is. The low right there. Let me see. Yeah, the low right there is 2291 and 2296. So that obviously is very close. And the RSI is hitting there. So if we were to get above 2350, 2380, and it has that down flag up pole look, it could get back on the bicycle in a big way. So I'd be watching it very closely. But this monkey in the middle stuff is not my cup of tea. Here you're guessing. And you could guess right. All right, what about oil? You know, oil is doing good, and in case you haven't figured it out, it's doing very poorly now, very poorly. So let's find out why that would be. Crude oil, again, one thing I heard is obviously that there's a lot of pumping going on by these companies. Chevron announced that they're increasing their supply. So look at it here. Crude oil, 20-year graph. Look at that. See, remember I tell you, if it gets above these lines, but the lines are pointing down, it's not going to last. We just had a little rally here to where? About 88 bucks, right? But the green line's pointing down still, and blue's kind of flattening out, but not much. But again, the green is definitely a problem, and the green comes in at 81, both of them, green and blue, coming in around 82.50, 81.50. We're down at 73 here in the May contract. Oh, that's for 25. That's because of backwardation. Let's see what's going on in the July contract. Sorry about that. This shows you there's still tight supply. See, we're in the front month here of 78 bucks. A year out, 25 is at 73 bucks. That's backwardation. That means tight supply. Now, again, though, critical point we're at, right? Because if they can break this thing under 79 and keep it there, and get the other two averages, which they're all inverted to the downside, if you know what I'm saying. That means, look at that. Your red line is at 79 and change. It's under the 24. It's under the 36. That's inverted to the downside. And if they break that, can you see where the support is? 62 and 69. So I would say oil's at a very critical point here, and the RSI is sitting right at 50. So if you start seeing it trading underneath 77 or something like that, I would say that it could be in trouble and could go back and test those other numbers of 70 bucks or 62. And the oil shares have been no friend to anybody lately either. And look at that. You see it can't get above the purple line. That's why I say you got to get above 85 bucks if this thing has a future. That's why I'm not interested until it gets above 85 bucks. Then I'm very interested. Because right now you're churning around and it's hoping to do this and that. It still looks okay, but I say under 77 and sustained under there, that would turn all this stuff to the downside. So we got to be careful. And then of course there you go. On a 1-year basis, this thing told you to get out at 84, pointing down. And then basically everything's pointing down now a little bit. And now we're way down here. So if it holds down here, like I told you, 77, 76, whatever, into this neighborhood, if it can hold down here, then you're okay. And it can build back up. But, the way the money is made is when the red line's pointing up and everything's going up. That's when the money's made. Right now, it's tougher. It's tougher. That's all you can say. It's tougher. And everybody says the summer driving season is coming. Well, maybe the summer driving season got bought in January and sold in April. Because right now, that's what it looks like. So people looking for these big, huge up moves in oil because the summer driving season, that might be how they get caught holding the bag. Because the smart money might have bought in advance and sold it to all the people that think the summer driving season is a big deal. We'll find out. Okay, let's see here. All right. So that's oil, that's gold, that's stocks, that's interest rates. How about that US dollar? Anybody interested in that? We're going to talk about it right now. Okay, so on the US dollar, and I've been saying this all along, let me tell you exactly my feelings on it. Up here, I'm telling people it's going to revert to the mean, which means coming down towards 105 or 100, which is exactly what it did. Then I told them if they could hold 100 and turn back up, it could start rising again because blue's pointing up and it's holding blue and it's rising here. So the bottom line is, as long as the dollar index can stay above, I say 104 is my number, then I think you're okay. If it can't, then something's gone wrong with the dollar. If we start ever cutting interest rates, I would think the dollar could have trouble. But bottom line is, these trends are up. And again, there's my 104 number. So want to be bullish, stay bullish up at 104. Could it pull back because it's extended? It could. On a 1 year basis, could it pull back? You see, back towards 104, it could, or 105, right? And you are getting a little bit of what they call divergence up here. That is a sign of weakness. So be careful on the US dollar up in this neighborhood, but the traffic still seems like it's going north. There's a lot of stuff going on overseas with China. I follow that very sharply. A lot of stuff going on with Mexico and their nearshoring. A lot of things going on in Europe. A lot of things going on with India. And so on the international picture, I watch that very closely. There's a lot of stocks to cover here. Palantir, we just talked about some of the ones we're moving this week, some bad ones like Intel, some better ones like Qualcomm, and Meta, of course, had big rallies, but a lot of them are giving back as soon as they get out of the chute. This week here, we've got Disney, Occidental Petroleum, but again, Devon Energy beat on earnings, but I think their revenue came up a little light. Some of the gaming stocks like Caesars and MGM and Las Vegas Sands are having a hard time. So this is an excellent time to get a hold of me because I am going to be able to send over the link I use for my timing, which also includes psychology, meaning, is positioning way high or way low, discipline, follow the averages, stick with them, and of course, the relative strength. What is the relative strength of the market? And I can share with you those acceleration points and on the upside, or deceleration where the market accelerates to the downside on the RSI. And I can share that with you as well. So when you do contact me, what do you get? You'll get the link that I can send over with the indicators. You'll get a 1-hour meeting with me online where I will show you how I do, what I do, talk about option strategies I like, talk about what you're doing, see if we can make you do a little bit better at what you're doing. And then you have the hour meeting. And then, of course, if you have a question on something, you can call me and ask. So I've got extensive experience. I have taught options and trading for a long time. I can deal with new people because I can explain things on a clear basis. I obviously have a lot of my own little techniques. So if you're experienced, the likelihood you could learn from me is quite high in my view. So the way you get a hold of me is pretty simple. You go to optionprofessor.com, OPTION, professor, PROFESSOR.com, and put your information in. Or you just email me, optionprofessor@gmail.com, your information. I call you back. Hi, I'm Jim. Hi, Mr. Jones, Mrs. Jones. I see that you're interested. Let me explain how I can help you. Tell me what you need to know, what you need help on. Let's see if I can do that. And we see if we can match up and make you a better trader. I think, obviously, I believe I can help, so that's why I offer it out. So I'm Jim, the Option Professor. It's optionprofessor.com to get your information to me, or optionprofessor@gmail.com. And then we'll talk. And I think I can help you, but you decide that after we speak, and there's no cost or obligation to talk to me. So again, get a hold of me. Let's see what I can do for you. Thanks for being here today. I hope you've enjoyed the other speakers. This is Jim, the Option Professor, signing out. Good luck and good trading, everybody. And I can't wait to talk to you.